Hello to everybody and welcome back to my channel. Today we're going to be talking about the Canada-US tax treaty, and specifically how this treaty saves you money and sometimes might cost you money. If you earn or invest or retire across the Canada-US border, the tax treaty between these two countries can save you thousands of dollars, but in some cases it can end up costing you. Last year I did a full breakdown of the treaty basics. Today I'm going to sharpen the video a little bit and discuss specifically how this treaty really hits your wallet now in 2025. So first, a quick recap of the treaty. Starting with a quick refresher, the main purpose of the Canada-US tax treaty is to prevent double taxation and clarify which country has the first right to tax your income. Covers everything. Covers things like salary, pensions, investments, capital gains. Sometimes both Canada and the US claims you as a resident. That's where the treaty's tiebreaker rules come in. These rules decide where you are truly considered a tax resident based on where your permanent home is, also based on where your if it's not clear where your permanent home is, then sometimes based on where your vital interests are and so on. And then there's a big caveat called the saving clause, which the United States always puts in their treaties, which that is something that's unique for the United States among most other worldwide countries, where they reserve the right to tax their own citizens and green card holders on worldwide income, even if they live in Canada or anywhere else in the world. So that clause makes the tax treaty very different for Americans compared to Canadians. Unique tax complication that Americans need to consider. So how does the treaty save you money? Let's start with some clear examples. First, withholding taxes. Normally, the U.S. withholds 30% on dividends paid to foreign non-U.S. residents, people that are living abroad. With the Canada-USA tax treaty, that drops to 15%. And for many types of interest income, the withholding goes all the way down to zero. So that's an immediate savings, but you have to file the right paperwork, like a W-8, usually the form W-8-BEN, with your U.S. financial institution. Second, retirement accounts. The tax treaty says that you can hold U.S. investments inside your RRSP or inside your RRIF, and the U.S. does not withhold any tax on the dividends or the interest. So your retirement investments can grow faster because they're not being trimmed by the IRS each year. The third is avoiding double tax on income. Suppose you're a Canadian resident working in the United States. You pay Canadian tax on your wages, but you get a credit for any U.S. tax withheld. So the result is that you pay tax only once, roughly at the higher of the two countries' rates, but not both countries' rates. The reverse works if you're a U.S. resident with Canadian income. There's also short-term work exemptions. So the treaty says if you're in the other country, so you're an American, for example, you're working up in Canada, you're in the other country for less than 183 days, and you earn below a certain threshold, you may not owe any tax in Canada at all. That's a real savings and it's a savings in terms of convenience and compliance because you don't have to file in Canada. The fifth is Social Security and pensions. So we've got the U.S. Social Security, and then we've got CPP, Canada Pension Plan, and Old Age Security in Canada, and the tax treaty specifies that residents of a certain country, so residents of Canada who might be receiving U.S. Social Security, do not have to report that Social Security to the U.S. at all. It's all reported and all taxed in Canada. Vice versa. If you live in the U.S., you will pay tax on your CPP and Old Age Security only in the U.S. So it prevents both governments from taxing the same retirement check. And then there's another one that's a little more complicated, but capital gains when you move. So Canada charges a departure tax when you immigrate, treating you as if you sold your assets on the day that you leave. The treaty allows a special step-up provision which steps up the cost basis of the asset. So for example, you leave Canada, you pay tax on this $100,000 gain, and then you move to the U.S. The U.S. cannot tax that same $100,000 gain again when you eventually sell. So how can the treaty cost you money? The treaty is really meant to save you money, but there are some situations where it can cost you money. First, there's this savings clause. So you're a U.S. citizen or a green card holder, but now you're living in Canada. You can't escape the U.S. tax. So for example, if Canada taxes your income at 25% and the U.S. taxes you at 30%, you're going to owe that extra 5% to the IRS. In effect, you always end up paying whichever country has the higher rate on that type of income. Second is paperwork mistakes. You forget to file the W-8-BEN, you lose that 30% of your dividend instead of 15. You miss filing something, misfiling a treaty position on Form 8833, you miss filing your F-bar, you miss filing any of wide variety of specified tax forms for international tax reporting, and you can get fined up to $10,000 or significantly worse if it's gross negligence or criminal negligence. So compliance errors can quickly wipe out any benefits you could get from tax treaty benefits. The last issue is political risks. The tax treaty is a political document, and it's subject, of course, to change by either government. In 2025, the U.S. floated something called Section 899. You might have heard of it. It's called the revenge tax. It would have overridden the treaty and doubled the tax on Canadians' U.S. dividends and interest, which would have cost Canadian investors quite heavily. Thankfully, the U.S. Treasury pushed back, and Canada repealed its digital services tax, which sparked the dispute by purportedly targeting U.S. tech giants that were operating in Canada. So Section 899 does not look like it's passing now, but it is a clear warning sign that treaty benefits are not untouchable. They can change. So anything new in 2025? The big story was Section 899. If that had gone through, Canadians would have seen their U.S. dividends taxed at 30% instead of 15%. That's losing half of your return, or half of your paying double tax. For now, that one's off the table, but the scare shows how fragile the tax treaties can be when politics enters the picture. The second thing is Canada dropped its digital services tax in the summer. That was a main flashpoint with the U.S. Removing it helped diffuse the tension. For cross-border taxpayers, that's good news. The third is, while there's no new treaty protocol since 2007, both the CRA and the IRS continue to update their forms and instructions. There's more information sharing across the border. In practical terms, you can assume that whatever you file in one country is known to the other country. Other things, like, for example, the border crossing, they know whether you file tax or not. So, for example, sometimes you have Americans that are living up in Canada that are not filing their U.S. tax. Then you try to enter back into the U.S. Yeah, they know that you're not filing your tax, and they might cause problems for you there. So, to wrap up, the Canada-U.S. tax treaty usually saves you money. It lowers withholding taxes, protects retirement accounts, avoids double taxation, and coordinates pensions and capital gains. But it can cost you if you're an American abroad, if you miss the paperwork, or if politics disrupts the agreement. My advice is simple. Claim every tax treaty benefit available, stay compliant with the forms, and keep an eye on policy changes. Done right, the treaty will keep more dollars in your pocket instead of the taxman's. Thanks for watching.